All right. Hello, everyone. Greetings. Hopefully, everybody's having a great evening. I'm relaxing at home, and we're going to have some fun to go through performance and what's going on in the world of investing and global markets and all of that. So many things that are coming up, and I'll be talking about the performance of the portfolios. And so, yeah, just to say hi, I see Sati says hi, and also Kitiwat, Patana Wong. Good to see you, and good to see everyone. We're kicking off with about 80 so people, and hopefully we grow over time. And make sure you ask questions in the comment section. Love to see the questions, and happy to try to answer them if I can. So why don't we get started and go into the presentation? And I'm going to hold on. Hopefully you can see my presentation. There it is. All right. So we're going to be going through June 2023. We just got through June, and now, of course, we're on July 11th. Remember to ask questions in the chat. I'd love to hear your questions. So our allocation strategies are global and they're long-term. We're trying to gain from long-term equity returns and trying to reduce the damage during equity market downturns. They're also diversified globally across asset classes, regions, sectors, and companies. Now, I started adding this into every presentation because I really wanted to remind ourselves, why are we here? We're here to build wealth over the long term. This is not about trading, getting in and out of the market. It's about how do we set a plan that we can follow for the long term. One of the lessons that we've learned is to be broadly diversified and also to contribute regularly. This is a key to growing your wealth over time. And of course, stay invested. I was just talking in the Valuation Masterclass Bootcamp earlier tonight to my students about research that came out in the US that showed that they showed a period of time that the average mutual fund returned 10%, the stock market mutual fund, but the actual performance that the investor got was about 4% because they were buying and selling at exactly the wrong time. But when you contribute regularly and you stay invested, you are avoiding this and you're getting the most of the return. Now, in my book, How to Start Building Your Wealth, Investing in the Stock Market, I highlight 12 steps. Let's just review those steps. Create a plan and follow it. If you've got an advisor at Phenomena, they really are good to help you set up your plan. Number 2, keep investing simple. Number 3, start early because time really is money. Number 4, get real about stock market returns. I would expect about maybe 8%. Do it yourself. Avoid mistakes when you're young. Build wealth through savings, right? You're never going to build wealth if you're not seriously saving in your salary or any other. Keep your financial costs as low as you can. Diversify to reduce risk, and own both stocks and bonds, and trade in frequently, and finally stay invested and watch it grow. These are the 12 steps, 12 principles that you can use. And that's the book, How to Start Building Your Wealth. It's available in both Thai and English in the bookstore. And also I've got an online course, which if you're interested, let me know. So our goal is to deliver steady returns over the long run. Here you can see our 3 line is the first one we started with, the all-weather strategy. The blue line, we started with Alpha Focus. Now, Alpha Focus got hit kind of hard in the beginning. In fact, I'm going to grab my pen here for a second. Alpha Focus got hit as the market was starting to come down, as we can see. And then we've kind of leveled off at this point with Alpha Focus. We've got a little bit of a rise that's happened in all weather and a little bit of a rise right here in the inflation guard. These are the 3 different ones. And over time, I expect the Alpha Focus to start performing when the markets really go. So all-weather strategy was launched in February of 2019 and targets a 6% return. Alpha Focus was launched in October of 2021, and we're targeting an 8% return, which means it's more volatile also. And All-Weather Inflation Guard was launched in July of 2022, and it targets a 4% return. So these are our goals for what we're hoping to get from the performance here. Now, since Inflation Guard's inception in July 2022, the strategies have performed almost as expected. Basically we're kind of flat over that period because it has been a bit of a rough market. So we can see moderate risk at AWS has had the highest return, a little bit above the others, and the highest risk, Alpha Focus, has struggled a bit. It ranks in the middle, and ultimately we would expect over time, as you can see, the blue line, Alpha Focus, tends to outperform when the market's good. And hopefully we'll get back to that outperformance at some point. And of course, Inflation Guard is the one with the least amount of volatility, the green line. Now, we create strategies for many decades. However, not even a decade really is long-term when you think about investing. This is me when I was a little baby. That's me when I moved to Thailand. And that's me when I'm 100 years old. Kind of look the same as I do today, I hope. Our aim is to create strategies that perform over many decades. So sometimes people will look at it and say, oh, but it's underperforming right now or it's down. Yeah, but we've got a long-term plan and focus that we're trying to follow. And that's the reason why you won't find that I jump in and out of different investment alternatives. So we're going to review the performance. All-weather strategy was up 2.9% in June. Alpha Focus was up 2.3%, and All-Weather Inflation Guard was up 1.2%. So overall, June was a positive month for every fund. Then we'll look a little bit at the global outlook. So let's first start off with All-Weather strategy. Remember that it's global, long-term, and diversified. So since inception, the strategy was 4.2% above a 60-40 portfolio as of 10 July 2023. We can see that all-weather strategy in the month of June had a performance of 2.9% against the 60-40 benchmark of 2.5, so a little bit better. Our 25% allocations to Japan and developed Europe have done well. We weren't as heavily allocated to the US, but luckily with Japan and Europe, we've done well. Our 25% gold allocation dragged anytime you've got markets going up like they have been in June. Gold tends to underperform. But remember, we're not holding gold to make some big gain. We're trying to protect if we get into a down situation. The strategy was 0.6% below the 60-40 in the past month. So considering the past month, as of the 10th of July, our 25 allocations have had the opposite performance. Japan and developed Europe in the past month have done relatively poorly. So we're struggling a little bit right there. Gold was best and Japan and Europe were worst. So now let's look at all-weather Alpha Focus, which was up 2.3% for the month. It's global, it's opportunistic, and it's long-term. It's also defensive. Since inception, the strategy was 4.1% below the 60-40. That's as of the 10th of July, 2023. Here we can see that the strategy was 0.8% above world equity as of the 10th of July. And here right now, it's just been a difficult time. And what we can see is 60-40 has performed pretty well. But what I would say at this point is that I just hang on and stick to my strategy, knowing that when the market really comes back strong, all-weather Alpha Focus should be in good shape. Now, in June, the month of June, the strategy was 0.1% below the 60-40. And the strategy was 1.8% below world equity. World equity did very well. Our defensive tilts slightly underperformed world equity, but not by much. And gold performed poorly, as we saw in the other AWS. Now, in the past month, this strategy was 0.4% below 60/40. And considering the past month, as of the 10th of July, meaning the past 30 days, the strategy was 0.2% above world equity. World equity fell back, gold and bonds held up well, and that basically helped us. So now let's look at all-weather inflation guard. This is global, long-term, and defensive. So since inception, the strategy was 2.6 below a 40% equity, 60% bond portfolio. So it's been, kind of flat since we started. Of course, a huge part of inflation guard is not losing a lot of money. And so we're kind of, after fees, we're at 100.8. So we can see that the strategy was 0.5% below the 40/60 in the month of June. Our 5% world IT tilt was slightly below the world equity fund. The underperformance of the strategy was due to a low equity exposure and high gold allocation as world equity rebounded during that period. Now, if we look at the past 30 days, meaning from the 10th of July, the strategy was about on par with the 40/60. So this gives you a picture of how the strategies have done. Let's look at some global outlook. So first, start with equity. The 3-month government bond yield curve has risen to 5% from 2.4%. That's a doubling, and it's a pretty significant move. It's starting to level off. Central banks have been battling inflation while trying to avoid a severe recession or banking crisis. Expect higher rates, though at a slower pace, as central banks haven't yet got inflation down to target levels. Now, after the pause in June, the market expects another hike in July. There's a 95% probability of a 25 basis point hike at the next FOMC. So people are still thinking the Fed's going to hike. Now, here we can see the yield curve inversion, which has dived deeper. And all recessions in the U.S. since 1968 were preceded by an inverted yield curve. The average time from inversion until recession was about 1 year. And when we look at the 10-year minus the 3-month, that gets us about fourth quarter, we're going to be in recession. So that is one of the signals that tells me that we are potentially going into a recession. Now, a low unemployment rate means upward pressure on wages, which is inflationary, but it's also recessionary. Look at every time that unemployment came down, we got to a low point, we got a recession. Down, recession. Down, recession. And most of the time, what we're seeing is that when it's coming down to the lowest level, we're heading into a recession. Now, this is a great chart because it shows that the recessions that we had were pretty common. We had them pretty often. And we're in a situation where we've gone pretty long time now without a recession. And I would say we probably are headed for a U.S. recession, which would mean the Fed reducing interest rates. Here's what we can see right now. The investors out there for July 11th are basically looking at the Fed raising rates and peaking in November at 5.6 and then coming down to 4.3 by December of 2024. What you can see is this gap between these two lines. The gap here shows that expectations have shifted from May to July. People are expecting higher interest rates. So the market thinks the rate will peak in fourth quarter. And besides battling inflation and avoiding recession, the Fed also tries to avoid a banking crisis. The only thing the Fed seems willing to sacrifice are U.S. jobs. Now, valuations have definitely risen. We can see the rise in valuations happening here. We're getting almost up to 17 times. The average has been about 15. we're down pretty far from a 20%, 20 times PE, where we were really overextended. But also remember, net margin is super high at almost 10% and slowly coming down. As margin falls, which I think it will, PE will rise. And that's because the earnings start to become a smaller and smaller part of the calculation of the denominator in the calculation of PE. So world stocks valuation is now above long-term average. And while the consensus net margin has come down a bit, analysts' expectations appear to have bottomed. But I think we've got more to come down on that margin. Now, for the past year, we've said that we think the course will eventually be reversed. And I still think that central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And basically, I do think that central bankers are going to break some things like the banking system. Now, before I go further, I just wanted to say hi to everybody. I know we have maybe about 140 people on right now on different channels, and I want to thank you for coming on and listening. And also, I want to encourage you to share questions and ideas that you have so that we can talk about them after I finish with the presentation. So feel free to type your questions into the chat right now so that we have plenty of questions to talk about. There is a lot going on, and I really want to encourage you to ask any questions about your own situation, your portfolio, your investing ideas, or anything else. We've got about 170 people on, and I just wanted to say hi to everyone. Let's continue on with the presentation. Here we can see that EU and Japan trade at a discount to the US, and that's part of the reason why we've been overweight those two markets. The stock market is forward-looking and hates surprises, and the EU seems to have entered a recession. Sticky inflation and interest rate differential should lead the US, means to the differential relative to the US, will likely lead to further ECB hikes. And EU companies are resilient since they're used to operating in a sluggish growth environment. So Tisa, good to see you. Jessica, I hope you got some good questions. Good to see you. Being a global leader in industrial automation, the EU could benefit from reshoring, and China stimulating its economy would benefit Europe. However, I just had a second person visit me coming from China just the other day on Sunday, came over for a cup of coffee, and we were talking about what is going on in the Chinese market and the Chinese economy. And I have to say, it's a little bit scary. It seems like China has kind of lost its way, and that would mean that we don't get the big China recovery. Now, EU firms stand to benefit from Chinese stimulus. If China can get itself up, that would benefit EU, but it would also, of course, benefit the US. We have a 25% target allocation to developed Europe equity in AWS. Now, Japan firms would also benefit if China was to increase its exports. And basically, I would say that a China recovery could be good for Japan also. China was the largest export market for Japanese goods. Now, let's look at Japanese companies for a second. They've been hoarding cash for the past decade. Right now, the cash holdings as a percent of GDP are 44% of GDP. That's incredible how much cash is at these companies. The total amount of cash at the companies is about $2.2 trillion. Incredible. They're now sitting on $2.2 trillion, which is equivalent, as said, to 44%. Now, high inflation in Japan means the private sector is pushed to invest. Higher inflation can lead to private investments and higher consumer spending so as not to lose purchasing power. We've got a 25% target allocation to Japan in AWS. Small caps are typically more sensitive to economic changes than large cap. Getting hit harder by COVID lockdowns and recession fears, let's look at the recovery. Here we can see small caps typically perform better in recovery. So what I'm showing here is from February until June, and then from September to June, what we've seen is about in line. So Europe appears attractive, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. We have a 3% allocation to Europe small caps in all-weather alpha focus. Now, demand for care and drugs is independent of economic conditions or cycles. So medical procedures that were delayed during COVID are now driving demand. We've got a 17% allocation to world healthcare in alpha focus. And here, what we can see is that there's been strong movement in infotech, in this case, B Innotech, that we're using Bualong Global Innovation and Technology Mutual Fund. And much of the year-to-date recovery in the U.S. market has been driven by tech. Now, we think the momentum driven by the positive AI sentiment can continue, and we have a 3% allocation to the world infotech in alpha focus and 5% in inflation guard. Let's talk about infrastructure. We have a target allocation of 17% in alpha focus. We're benefiting from government's green energy security, and other infrastructure spending. Typically, predictable cash flows and able to push through cost increases from inflation. So infrastructure looks good to us right now. Now, precious metals don't always move like overall commodities, and we can see, looking at the two right here, gold and other precious metals to some extent can gain from uncertainty and recession. Palladium, platinum, and silver have industrial applications and are important for green energy and EVs. Precious metal miners can benefit from sustained higher prices. These are rough estimates of the profit margins the profit of miners on average can make at current prices. So silver is very profitable right now for miners, as well as palladium and gold. Platinum, not so much. Miners are also expected to move with a beta of greater than 1 relative to spot prices. So we've got about a 3% allocation in alpha focus. Let's look at bonds. Bonds are typically a safe place, even though 2022 was exceptionally bad. And basically, in the case of bonds, what I would say is that I went into the crisis over the last, let's say, 6 to 12 months, saying that we're not going to be heavily overweight equity because I'm afraid that equities could crash. And the result of that is that we would lose. So I feel like the upside in equity is not worth the risk of the downside to some extent. And that's why bonds are important. In recessions, safer assets like government bonds typically have performed well. Though with high inflation, low yields could still lead to negative returns. And we generally don't allocate the bonds to speculate on upside, but rather to use it to protect capital over time. Now, if the Fed starts to reduce rates, these bonds would outperform. I just want to take a second, welcome everybody here. I appreciate you coming, and hopefully you've got questions, and I'm happy to try to answer those questions after I finish with the presentation. So let's talk about commodities. Here you can see energy prices have come down, although they've started to bounce back up right now. That's European natural gas is what I'm really focused on. And we can see food prices have softened. They keep coming down. If it continues, it should have a dampening effect on inflation. Now, commodities have lost momentum as the global economic outlook has worsened. And we currently don't see a clear catalyst for energy prices to go significantly higher. Yes, OPEC seems to be tightening, but they could be tightening because they're worried that prices could fall more in a recessionary environment. So the main upside in commodities could come from a supply shock, adverse weather, or significantly higher demand due to improved growth outlook. I don't think it's likely right now. And the main one that I would watch is energy, because if oil prices really reverse, then commodities and inflation will both rise. We've got a 5% allocation in AWS and no allocation to the others. Let's talk about gold. Central banks have been loading up on gold. This is the gold demand year by year. And then in the first quarter of 2023, the first quarter is low because it's an annual figure for the others. So it's actually not that similar. Probably it's going to be close in potential there. So the recession risk remains, and gold goes up and down a bit, but overall it protects the portfolio. Again, if you have any questions, I just want to welcome you. We got about 180 people on, and I just want to welcome all of you. If you've got questions, make sure to leave them in the chat. So we keep a relatively high gold allocation in our strategies, which also serves as insurance in times of uncertainty. In general, gold protects value in times of uncertainty and market downturns. And I think we're going to be facing some uncertainty coming up. So what are the risks to our different strategies? Well, inflation could reaccelerate. If central banks aggressive rate hikes in QT, they could crash the market. Or if inflation reaccelerates, we could miss out on rising commodity prices. A high gold allocation could get hit by higher rates or an improved market sentiment. Before we get into the Q&A, remember the upcoming Valuation Masterclass Bootcamp number 11 starts on September 4th. Our limited super early bird price is still available, and with Phenomena, you can save $100 extra off of that. To get the extra $100 off on any price point, get it by using this code until August 25th. You save about $800. So use this code, Phenomena, when you go there. Just go to valuationmasterclass.com/bootcamp. All right, it's time for Ask a John Andrew. Any questions? I am going to now switch back and look at some of what you guys have said. So let's just go through again. Let's just say hi to Sati. Good to see you. And Kitty Watt, nice to see you. And there's Peach, good. Yep, one of my students there. And Crit, good to see you. Busara, good to see you. And Pira Saka. And here we see Nang Sao Anchali, I think. Hopefully I'm right. Tisa's there. Good to see you. And Gumpan says hi. And there's Jessica. Good to see you. And Laser, good to see you. All right. And One Chart says, do you think if China's stock market can go up in 3 to 5 years? My biggest fear about the Chinese market is that almost every American senator and House of Representative member seems to be on a war path going after China. And my concern is they're going to do things to hurt China, such as trade restrictions, such as restrictions on investing. So Americans may have a harder time investing in China. They may do some restrictions on Chinese companies listed in America. All of these types of things, they may try to get China out of the index. All of these types of things can potentially keep the Chinese market down. Now, that doesn't mean you can't make money in the Chinese market. Chinese market is very volatile. If we see it get hit particularly hard, then it may be time to come in. But for right now, I do think that there's a bit of a heavy weight applied through the U.S. Congress. All right. Santi said, should I start to invest in EU and Japan as AWS port allocation, or is it too late? Well, let me ask Alex, when is our next rebalance? And I can get that information to think about it. But I think we're probably about 2 months away from a rebalance. So I would say that you could basically get into the AWS allocations like EU and Japan. It's going to be early September. So we still got about 2 months left. So I would say, from my perspective, I would continue to make allocations to AWS. Once we get like 1 month or 2 weeks out from our rebalance in September, then I would say if you had new money coming in, I wouldn't put it in at that point, because by that time, you might as well just wait for the next change. Now, Laser said, if I dollar cost average in S&P 500, should I increase capital to that fund in the last 6 to 12 months? I'm not exactly sure what you mean, the last 6 to 12 months. Maybe you mean the last 6 to 12 months of this year, or if you're thinking about the next 6 to 12 months. Well, the point about dollar cost averaging is you don't really change the amount that you put in. You set it and you forget it. So I would say that based upon what I think you're saying, the most important thing about dollar cost averaging is you have to stick with it and keep contributing even in the down market time. If I didn't answer that question exactly the way you wanted, Laser, you can type that question in a little bit more clarity, and I'll do my best to try to answer it. Says, Sawadee ka. Sawadee ka. All right. Gan, good to see you. And how do I say that? Tanapat. Sawadee ka. All right. Jessida, here comes the big question from Jessida, the man. Do you think U.S. could avoid recession in the next 12 months while the ISM is at 46, yield curve super inverted, but market driven by AI theme? No, I do not think the U.S. can avoid recession. It is coming. It's just being prolonged right now. But I would argue we're probably in the recession right now. We're just not fully seeing it. I don't think that AI is enough to lift us out of recession. AI is something that can push up some portion of the market, but I would say that, that is a recession is coming, right? All right. Next question. So, Jessica, that's my answer to that. We got a recession coming. Okay, I have a plan to buy more 30% of SCBGLOB. What do you think? Okay, well, remember, first thing is I'm not your advisor, and this is not financial advice. When you need financial advice, you should turn to the financial advisors at Phenomena because they are phenomenal. They're great. But I can give you some thoughts, so let me do that. So the SCBGLOB fund is the Siam Commercial Bank or SCB Global Bond Fund. The master fund is T. Rowe Price Funds, which is a global aggregate bond fund, meaning it owns bonds around the world. It's medium term bond fund. So we don't have any allocations to it, but maybe it's something that we should look at when we want to get our money out of the market. Overall, when you say 30% of this, I would say that there's nothing wrong with that type of global bond fund, and the yield now is very high. So in the sense, you're kind of locking in a yield with a bond fund. Now, bond funds will go up and down over time, not the same as if you just bought a government bond. But I would say that with interest rates likely to come down, so Jessica asked the question about, are we going into a recession? And my answer is yes. And then the question then is what happens to interest rates? And I think that what's going to happen with interest rates is the Fed is going to start to reduce interest rates. And when they do, a global bond fund or a US bond fund should outperform. And meanwhile, you're getting a very high yield on it. So I don't think it's a bad idea. As far as the weightings and stuff, I don't, you have to look at it, your own situation, and talk to your financial advisors. All right. Remember, if you're going to join the Valuation Masterclass Bootcamp, use that Phenomena code to get $100 off. All right. Next. Hey, before we go to next, let's just take a moment. We've got about 190 people here, and I really want to welcome everybody. Your questions are great. Keep your questions coming. We still have some time. I won't get sleepy for a little bit longer. I feel strong today. And so for all of you guys, feel free to ask questions. If you disagree with what I'm saying, please ask a question and challenge me and let me think about it. Maybe you're right. I got to think about all these things. All right. T-Noise62 says, I still have some money left to invest, AWS and Alpha. Should I invest now or wait? I would say that, what I would be doing is the best advice that I can give is just dollar cost averaging. And I would say AWS is probably a good standard to go to. Alpha Focus is a one that's going to provide more upside when the market goes up. I don't know if you remember, but we saw a chart of Alpha Focus versus AWS. And in most of those market rises, Alpha Focus rose more than AWS. So it depends a little bit on your risk profile. If your risk profile, if you're able to handle the risk, Alpha Focus is a good long-term exposure to equity market. But if you say, well, Andrew, my risk profile is a little bit lower, then I would just say go with all-weather strategy. All right. Okay, Yim says, hello. Well, hello to you. P. Chit says, what is your expectation on the coming CPI, PPI, and US dollar this week? That is a very short time horizon. But I would say, first of all, the upcoming announcement of CPI, I expect to keep coming down. By the end of this year, I think CPI is going to be at 3% in the US, down pretty massive. I think we're going through a deflationary period and an economic recession. Now, I could be wrong. If oil prices really race up, then it becomes it becomes an inflationary period in a recession, which is stagflation. So overall, I would expect that CPI and PPI are coming in falling. As far as US dollar or Thai baht, I would say that in a environment of recession or uncertainty, it's very possible that the US dollar could continue to strengthen, and that means a weaker baht. In chaos or in difficult times, money tends to move to the US. So I would say that a weakening Thai baht relative to the US dollar or a strengthening of US dollar is very possible. Orotai says, hi, Guru Andrew. Nice to see you, Orotai. All right, Petch, good to see you. Petch came over this weekend, and we had a great talk about life and many other things. Good to see you. All right, we've got 191 people on this call. You guys are awesome. It's great to see everybody. We still have some time, so please ask your questions in the chat. All right. Joy says, please advise on how to do with my current investment with the China funds. Yeah, it's hard, Joy. I know there's plenty of people that have been burnt on China. The first thing I would say is always remember China is a very volatile market. And that means you really want to implement some sort of stop loss when you invest there. I'm not sure what to do with the Chinese funds, but what I can say is I don't see a strong recovery coming out of China right now. And I think the sentiment against China, particularly coming from the US, is strong. And that tells me so Joy, let me tell you one thing to think about. This is the concept of zero-based thinking. Let's look at your situation, Joy, and ask yourself, if I didn't own this Chinese market or Chinese fund, would I buy it today? If the answer is yes, then hold on. If the answer is no, then maybe you've got to take the loss and allocate the money to another investment that you think has higher potential than the Chinese market for performing. It is an impossible question. It is a question that's very hard to get right. It's a question that everybody is faced with at times, but really that is the answer from my perspective. All right. By the way, if I don't answer your question that well, feel free to clarify and ask more detail, and I'll do my best. All right. Boot Sarah. I like your last name. At first, I thought it says Boot Sarah Supermodel. When will the next global recession happen? Your expectation? I would say we're probably 2 or 3 months away from the start of the next global recession. That's my answer to that. Satawat, good to see you, Arthur. I want to ask you your expectation prediction about the gold market. I think right now, because the equity market has been strong, gold has underperformed. But I think if we do see a weak market in the US or globally because of some risks related to recession, then you could see that gold does well. But when the market's doing well, gold tends to underperform. So that's what I would say about gold right now. Ashwani says, what should be the current investment strategy with an outlook for the next 12 to 24 months? This is a good question, and it's a hard one. The problem that we have is that if I look at the US, I think we are only months away from a potential recession. What's going to happen? The stock market's going to fall. The economy's going to fall. Sentiment's going to turn bad. The stock market's going to fall more. And it's very possible that at that point, the Fed will start to reduce interest rates. I think that if the market really starts to fall, what we're going to see is that the Fed will actually potentially buy stocks. If the Fed significantly reduces interest rates or starts to buy stocks, it's going to put massive upward pressure on stocks. And the result of that is that we may have what I would call the final boom of the stock market in the US. And that's part of the reason why the next 12 to 24 months still kind of makes sense to have equity exposure. So that's what I would say. My expectation is a recession and then stimulus coming from the Fed in the US as demanded by Congress and as demanded by the people, and therefore the market starts to rise. So this has been a weird year in my perspective. All right. Yim says, what do you think? Should invest in Indian market and European market compare with S&P and NASDAQ? I mean, the Indian market, what I like about the Indian market is, number one, the economy is growing. And number two, it's not as highly correlated to the US in particular. So when you compare it to S&P and NASDAQ, the correlation is much lower. But S&P and NASDAQ have been doing really strongly recently, so it's hard for India to outperform. I think that having India and Europe, at this point is relatively low risk. We do not have India as an overweight in our strategies right now because it doesn't look attractive to us. But we do have Europe. So maybe the best thing is to first start looking at Europe. Thanks for sharing. You are welcome. Yeah, India. I think, as said before, it's very possible that India, can be attractive, but it's not attractive enough relative to other countries that we've decided to get into India. And therefore, it's not that attractive. But I do think in a down market period, India in a recession and US stock market falling, India has a little bit of a defensive nature to it. Gerard Road says, hello, good to see you. All right, let's keep going. Laser says, actually, I'm looking for the cost price of passive fund as cheaper also. I'm not so sure if market has a little bit crash. I'll get some lower price in my portfolio. Yep. Okay. So I would say that we probably are heading into a little bit of crash. So you will potentially have an opportunity to buy in your portfolio. Yes. Good to see you. Yes, I am fine. I am, and I appreciate that. Test. I am in Bangkok, Thailand at my home at Sukhumvit Soi 12 behind the Sheraton Grand Sukhumvit. My mother is right in the other room. I'm probably talking loud and she can hear me. She's asleep, relaxing right now. How do you think about global REIT investment now? Is it low enough to start getting up or not? REIT is interesting. I think that REITs can be valuable in recession period. So, and good REITs, and I think Thailand has some pretty good REITs. REITs that are listed right now have survived the COVID crisis. That means they're pretty strong. And the only problem I find about REITs is that REITs are already in the stock market. And so when you correlate REITs in general, you find that the correlation is very high connected to the stock market. So the first thing I would do is say, make sure that you have stock market exposure and make sure that you understand that REIT exposure is really just more stock market exposure. So you could look at individual REITs or REIT funds or a fund of funds type of thing that has a lower correlation with the stock market. And then I think you've got a really smart REIT strategy. Okay, Jatupat says, after the announcement of second quarter financial performance, will there be the continuity of stock rally? Will the sector rotation happen given that only 7 mega cap companies outperform due to AI trends? So I would say that I expect weakness in the market after the second quarter numbers come out. I also expect that at some point, the tech companies are going to start to underperform again because AI is happening. I don't know how much profit they can make from it right now, but everybody's adopting it. So it's not just, of course, it's not from it. All right, let's continue on. Pichit, you're welcome. All right, next, Tanida. Let me ask if S&P, NASDAQ, China are still interesting to DCA via RMF about 10 years. Well, remember, with RMF, you really are looking at long-term and you're kind of locked in there. So I would say that they're okay, but I wouldn't I wouldn't overweight China right now. I would just keep it kind of neutral. And the problem, if S&P and NASDAQ are both exposures to the US, and I don't know, to what extent you're getting a correlated return, meaning when S&P goes up, NASDAQ goes up, and when NASDAQ goes up, S&P goes up. It's not always the case, but you just want to be careful and think about your exposure to the US. If you combine S&P and NASDAQ, and that's your exposure, I think you don't want to be, more than maybe 50 or 60% to the US. All right. So I would say that it's still interesting to DCA because DCA is all about setting a long-term plan. The only thing I would challenge with this is that it may be more interested for a RMF. It may be better to have it be a really broad-based index fund type of thing. All right. Jiro says, do you have any idea about Australian stock market? No, I don't have much idea about it. So unfortunately, I haven't looked at it for a while. Daisy Fern says, from your views, if the U.S. will face recession in fourth quarter, does that mean it's the bottom? And what kind of industries in the U.S. market interest to invest at that time or got the benefits and continue to invest? I would say that right now for the U.S., I think one of the smartest investments is midterm government bonds because you're getting close to 5% and you're locking that in. So if interest rates come down, you're going to see a rally happening in the bond market. And that means that a mid maturity bond fund should do well. And so that's kind of the way I would look at the US. You go in with a bond fund right now. As soon as interest rates start to fall, the market starts to fall, then you start to reduce your bond allocation and increase some equity allocation. And I would just do a broad-based equity allocation because if the Fed starts lowering rates, equity is going to rise. Now, the bonds are going to rise too when interest rates come down, but the equity should be a pretty wild ride. As far as the sectors to concern on equities, when you go into a potential crisis, you want to be in defensive, like utilities, like healthcare, like infrastructure. And then once the market has come down or crashed, you want to be able to switch that money out of that and into more speculative sectors like the industrial sector, as an example. And ultimately, this is like trying to switch in and out. Ultimately, that's hard. I mean, I spend 24/7 working on that, and it's still hard for me. Jessica, Bank, and others at Phenomena also spend full time trying to adjust it. So it's not that easy to time the market. And that's why for most people, they should just stick with dollar cost averaging. All right. Aswani says, thanks a ton. You are welcome. Test says, Warren Buffett bought more Dominion Energy. Could valuation cheap in 5 years? What does he think he has in mind to hold this now? I think that what's happening is Warren Buffett knows that there's no way the world can replace oil. But everybody's trying to restrict the amount of oil that's being produced from the climate perspective. And as a result, if you can reduce the supply of oil, you're going to increase the price of oil. And I believe that Warren Buffett is playing the theme that we're always going to use oil. And number two, that all the pressure on oil is going to eventually raise prices on oil. All right. Next is Supergone. Good to see you. Okay. I am retired. Is AWS suitable for me? I would say yes. AWS, I mean, we'd have to look at your portfolio and your assets and all of that. And I think you can do that with a financial advisor at Phenomena. But the good thing about AWS is that it's a little bit less risky than Alpha Focus. And yet it still has pretty good returns. So I would say AWS is suitable, but make sure you check with a planner before you go rushing into any of those investments. What's your view on Japanese market? Expensive already, or still able to maintain position? I think the Japanese market still has further to run. And so we remain overweight the Japanese market right now. But I suspect, that it could be by the time we rebalance in September, that changes. But for right now, I would still stick to the Japanese market because it's still relatively cheap from my perspective. Superwan says, what is your perspective of the Thai economy? Are there any outstanding sectors for next year? I think that if the U.S. goes into recession, Thailand's going to be hit very hard. And if that happens, I think the banking sector could be suffering over the next, let's say, 12 months or so. So as far as economy, if U.S. goes into recession, Thai economy is going to get hit. As far as sectors to not be exposed to, I would say it's very possible that banks are not the right sector exposure because they could be going into a recession, and that means that non-performing loans rise. I also think that sectors like real estate, as an example, are not that great in a recessionary environment because we know that the revenues of those real estate companies is going to come down a bit. In a recessionary environment, you would have healthcare, infrastructure, consumer staples as some of the foundation of a portfolio. All right. Sawanya, good to see you. Thank you very much. All right. I think this is our last question. Monica Sao says, what is your view on Thai corporate bonds at the moment? Also, market under new government. Thank you. Monica, is there a new government? Well, actually, at some point, we're going to have a new government. I think that the overwhelming theme for Thailand will be U.S. recession and the impact on Thailand. Thailand already has pretty low interest rates and low inflation. And therefore, Thai market has some, I would say the Thai market could be kind of a safe haven, which is pretty amazing when you think about it. But so corporate bonds at the moment seem okay. But if we go into recession, we could see that corporate bonds fall in value because people start to worry about the credit risk, and people would prefer to own government bonds at that time. Wow, that was a lot of questions. I want to thank you guys for all the questions, and we're come to the end of the hour. And it'll be September when we do early September when we do the next rebalancing. So the next time we meet is kind of update on what's going on. I just want to take this moment to thank everybody for joining, thank everybody for, following me and what my team and myself are producing through Phenomena and all the support. I love the questions. You guys are making me think, and it's always good to think as we get older, right? All right. Have a great evening, and I will see you soon. Maybe see you in the Evaluation Masterclass Bootcamp. Bye-bye.